Hello, I'm Angeline Ong and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Coming up, Inflation Watch traders brace for those CPI readings from the US, China and Japan. Boeing indicated lower the aircraft maker's groundings of some 737 MAX 9 jets have a drag on airline stocks. And oil slumping more than 2%. Sharp Saudi Arabia price cuts and an OPEC output rise offset supply concerns. Well, we'll have more on that in just a second when we cross over to Chris Vecchio from Tasty Live in New York. But let's have a quick look at volatility and Wall Street as well, because just looking at the chart here, this mirrors the Dow Jones Industrials really sitting on the fence there. Investors braced for this open with pressure coming from uncertainty around interest rate cuts and also a fall in airline stocks after the grounding of some Boeing jets. On the economic front, not only do we have those big US bank earnings expected end of the week, we also have CPI, and ahead of that, the Fed expected to report consumer credit probably rose to $9 billion in November, from around $5 billion in the month before. Now let's cross live to Chris Vecchio all the way from New York. Chris Vecchio from Tasty Live, part of IG Group. Chris, thank you so much for joining us. Is it all about that CPI figure this week?
Excuse me. Quite frankly, yes, it is. Because this is a barren economic calendar. And quite frankly, it's a barren earnings calendar until you get to the end of the week. Look, we're just coming off of non-farm payrolls on Friday, which was a fairly mixed, I would dare I say, deceptive report. While you did see that the unemployment rate dropped, that headline jobs growth was better than anticipated, it ultimately comes as a large number of workers leave the labor force. And perhaps just as important, you're seeing that the composition of jobs is dramatically changing. Workers reported nearly 700,000 fewer jobs last month, and that would be a deflationary impulse making its way through the economy. So as we look to CPI this week, this could actually be the final hurrah where CPI is a little bit elevated. Base effects, once you go into the January, February, March data series moving forward, cater to headline pressures coming in very, very rapidly. We're talking about a mid 2% figure could be had by the end of this first quarter. And so right now it's all CPI this week. You mentioned those bank earnings on Friday. Those will be important as well, particularly as we make our way through this fourth quarter in which we did see those bond yields drop at some of these banks that have been encumbered by the depletion of treasury asset values over the past year, which facilitated the wind down of First Republic and SVB. How are banks doing on the other side of this environment? Yields did come off very sharply in the fourth quarter. But yes, CPI, that is Thursday. That is what everyone is paying attention to and talking about this week.
Now, oil price is also quite fascinating. We're seeing this fall off of more than 2% as we have two situations, one on the supply side and the demand side offsetting each other. But how does this all feed into that, those incoming CPI figures from the US in the coming months?
Well, just like for the Eurozone or the UK, headline CPI in the United States takes into account energy prices. And so the fact of the matter is energy prices, that they have come in a fairly decent amount over the past several weeks and months, and they have not really seen any upside traction. They are a negative contribution right now, if you're in the United States, if you're in the UK, if you're in the Eurozone, to those inflation figures. And so it's certainly a welcomed step forward when you look and you see that crude prices are down 2%. Saudi Arabia, of course, announcing that they're cutting the price of their flagship light Arab crude that they sell to Asia to its lowest level in 27 months. Typically, oil producers don't cut prices unless they feel like they are dealing with waning demand, and that is definitely a problem in this global economy right now. The United States may not be slowing down as much as people thought it would at this point in time, but that doesn't mean that Europe or Asia are out of the woods right now. Oil markets, to me, though, are very interesting because they contain a lot of volatility right now. In that sense, if you're out there looking to range trade through iron condors or even selling put spreads, seems to be a very viable opportunity here in the coming days, just because this is a volatility profile that we really don't see anywhere else in the market at present time.
Thanks very much, Chris Vecchio there from Tasty Live. I'm sure I'll be checking in with you after that CPI number to see how the ground lies. Let's take a look at one industry that is very, very much in tune with oil prices, and that is the airlines and airline aircraft makers. Boeing shares, let's check in on that because the shares nosedived earlier after the US Federal Aviation Administration ordered the temporary grounding of some 737 MAX 9 jets fitted with a panel that blew off an Alaska Air Group jet in midair on Friday. The shares here on the IG platform down 6.7%. There are now real concerns that Boeing could come under quite a lot of checks after this finding. The aircraft manufacturer could lose around $12.5 billion in value if losses hold through to the market open. This is the cash open. What's also interesting is that other airlines are also on our radar. Let's just check in on Alaska Air. You can trade this in when the cash open starts, but also I can tell you that JetBlue is another one we're looking out for. Now, the thing about the airline industry is, you remember, Airbus has had quite a few issues of its own. Boeing did very well, and now with this issue, it's seen as it's now Boeing that is under the cosh. So we're awaiting more details as that comes out from Jefferies, a note which says that the latest Boeing incident could slow aircraft production. Now, this is if manufacturing and installation processes are subject to further regulatory probes. This is according to a note from Jefferies. Also, another key story that we are looking at today comes from the Bitcoin space. Crypto exchange Coinbase, its shares, just checking in on that, it is rising. This is the all sessions picture for you on the IG platform, currently up 2.6%. This is after brokerages issued a rise in price targets on the stock. Brokerage Needham says Coin is its top pick for 2024 and adds the stock to its conviction list. Now, crypto markets, as you know, have rallied since June. Many traditional financial firms such as BlackRock have joined in the race to seek regulatory approval for a spot Bitcoin ETF. Coin itself, Coinbase rather, well, it surged 391% in 2023. This means it outperformed broader markets and major Wall Street indices. Now, one of the other big stories, of course, ahead of the CPI figure is the US dollar. It remained steady after being shaken by that Friday jobs number, which was very robust. The data did show that the US economy created 216,000 jobs in the last month of 2023. Now, this is more than 173,000 in November and higher than the 170,000 expected. The unemployment rate remained at 3.7%, and the average hourly earnings rose to 4.1% year on year after 4% the previous month. Economists saw it cooling to 3.9%. The labor market is no longer as tight as it was earlier in the year, but job growth remains solid, which leads economists to think that Fed funds rates will remain unchanged for the next few months. A week ago, market pricing showed a 90% chance of a Fed rate cut in March. Post non-farm payrolls, this is down to 64%. The next test for the dollar, as I mentioned earlier, will be the CPI. Just bring up the dollar index here for you, or the dollar basket, as it's known on the IG platform. Headline CPI should come in at 3.2% year on year, one notch higher than the previous month. Core CPI growth also expected to accelerate to 4% year on year from 3.8% the previous month. Now, ahead of that CPI figure, IG's Axel Rudolph has been looking at another index that's done really well in 2023, and that is the tech-heavy NASDAQ. Axel is here with the next levels to watch.
The NASDAQ 100 is really interesting because it started off the first week of 2022 by dropping by about 3.5% as sector rotation out of tech stocks and into banking stocks, for example, had a negative impact. And you can see that here on the daily financial bet of the NASDAQ 100, where we slid down to 16,178, just marginally above the late November highs of last year, which may actually act support going all the way down to 16,126. And as long as that area holds between 16,178 and 26, I wouldn't be surprised if we were to see a slight recovery in the NASDAQ 100, take us slightly higher towards 16,500, or perhaps even the 20th of December low at 16,551. As first of all, congressional leaders in the US reached an agreement reducing the likelihood of a shutdown, and also ahead of Thursday's US CPI inflation data release. So technically speaking, it looks as if we could see a minor bounce with regards to the NASDAQ 100. The question is, will we be able to actually take out the previous high from December? Because as long as we don't do so, it is still possible that we might actually see a much more brutal decline in the NASDAQ 100 over the coming months. So watch this space closely. Support to look out for 16,126. As long as we stay above there, I expect a reversal to the upside to be seen at least short term. Failure there at 16,126 would probably put the December low at 15,692 back into play.
Thanks very much, Axel. Now, other than that CPI data, as Axel mentioned, out of the US and also China and Japan later in the week, it's a mega week for earnings with big US banks kicking off the party. Here's Liberum's head of strategy, Joachim Clement, with his view on what traders can expect to hear.
Obviously, because this is Q1, this is the most important earnings season of the year where we see full year results. And we start off obviously with JP Morgan, Citi, Bank of America. Those are the guys that will set the tone as they always do. We do expect them to present relatively good numbers given the strong equity markets and bond markets in Q4 and the continued high interest rates. So banking profits should be really high, as well as trading profits, which should have improved compared to Q3.
Well, let's get into the detail of what the market is expecting. JP Morgan set to report earnings of $3.53 a share, down 0.7% on the same quarter a year ago, but sales expected, or rather revenue expected, to rise by 11.8% to $39.8 billion, boosted by the ongoing integration of First Republic Bank into its business. Now, in the last 12 months, JP Morgan performed better than its US peers, gaining around 27% in the period. Since the very end of October, JP Morgan shares have been almost constantly rising, setting a new all-time high last Thursday. On the other end of the spectrum, Bank of America, EPS expected to fall by nearly 20% to 68 cents. Revenue also seen falling 2.6% to $24 billion. Bank of America lagging the broader industry in 2023, only gaining around 0.9%. And underperformance partly due to a slower recovery from the March 2023 US banking turmoil. That said, the stock has gained 37% since the end of October, now trading at a 10-month high. Now, in Q4, bond yields fell on expectations of rate cuts ahead. US 10-year Treasury yields easing sharply from a just over 5% peak to just over 4% currently, and falling yields may aid to ease some pressures on the bank's funding costs. Wells Fargo and Citigroup, the other two banks to report late in the week, Goldman Sachs and Morgan Stanley to report on Tuesday, the 16th of January. Now, let's take a look at commodities now and gold prices specifically. Well, it slid to trade near a 3-week low touched in the last session. This is as the US dollar and bond yields were buoyant on dial-back hopes of an early rate cut by the Federal Reserve, and of course ahead of that CPI number. Also keeping an eye on oil, as you heard Chris Vecchio earlier, oil, a lot of volatility, but our clients like that on the IG platform. Oil still down. If you look at Brent there, down around 3% so far in the session. Let's take a look at WTI for you, which is called US crude on the IG platform. A similar picture there. And still a far cry from the highs seen when Russia invaded Ukraine, or just after thereabouts. John Evans, an oil broker at PVM, says that oil watchers rightly questioning that Saudi Arabia's cut is not only aimed at quelling interference from non-OPEC supply, but also from its very own cartel membership. Now, before we go, a quick look at how the market is looking. We're now minutes away from the cash open. Wall Street looking like this at the moment, still on the fence, really. As you can see there, pretty much treading water. Let's have a look at the volatility index. Volatility still very low at around the 14.7, 14.8 mark, as we look for more clues as to when we're going to get that interest rate cut from the Fed. Well, that's it for this edition of Beat the Street, the show that gives you the trading action, helping you position yourself ahead of the Wall Street Open. For more trading insight, do follow me on @Angeline on and on @IGCom on Twitter. This is IGTV.